The carry collapse trigger isn't in Tokyo, it's inside the repo market. The Bank of Japan raised rates. The headlines moved on. But here is what the institutional balance sheet data is showing, and what every XRP holder needs to understand before the next liquidity shift fires. The yen carry trade is a leverage mechanism, not a trade, not a strategy. A structural funding pipeline that has been quietly underwriting speculative risk across every correlated asset class, including digital asset corridors, for over a decade. When that pipeline contracts, it doesn't contract slowly. It collapses in a compressed liquidity cascade. And the trigger for that collapse isn't the Bank of Japan's rate announcement. It's the repo market haircut threshold. Let's audit exactly how this works at the clearinghouse level. The yen carry trade operates on a structural mechanic that retail finance coverage almost never explains correctly. Institutional counterparties borrow yen at near zero interest rates. They convert those yen into higher yielding assets, US treasuries, equities, digital asset corridors. The yield differential between the yen borrow rate and the target asset return is the profit engine. When the Bank of Japan holds rates near zero, the carry is wide. When the Bank of Japan raises rates, the carry compresses. But here's the clearinghouse friction point that retail analysis completely skips. The carry trade isn't just a borrow and invest loop, it's collateralized. The yen-denominated positions backing those trades are posted as collateral inside repo market clearing loops. When the Bank of Japan raises rates, the yen appreciates. An appreciating yen means those yen-denominated collateral positions increase in nominal value, temporarily, but the repo market clearing engine applies a dynamic haircut to that collateral. As yen volatility increases, the haircut expands. A wider haircut means counterparties must post more collateral to maintain the same leverage position. Here's the part they aren't telling you. Most institutional counterparties running yen carry positions don't have excess collateral sitting idle. They're fully deployed. When the haircut expands and margin calls begin, they don't go to cash reserves first. They liquidate the most liquid correlated positions immediately. Digital asset corridors, equities, speculative fixed income positions, that's the liquidation cascade sequence. That's exactly what August 2024 demonstrated when the Bank of Japan made its initial rate adjustment. The Nikkei dropped over 12% in a single session. Digital asset corridors compressed sharply across the board, but the full carry unwind didn't fire. The Bank of Japan verbally intervened and stabilized yen volatility before the repo market haircut threshold triggered a full margin cascade. That verbal intervention bought time. It didn't close the structural position. The yen carry trade is still open, the positions are still fully deployed, and the Bank of Japan is still raising rates. Look at the numbers. The Bank of International Settlements puts the conservative cross-border yen-funded position at approximately $4.2 trillion in direct lending exposure. When you include synthetic derivatives and repo-backed leverage amplification, the realistic upper bound is significantly higher. That's the notional position sitting under the current rate structure. Now, here is what actually triggers the full unwind, and this is where retail analysis consistently gets the mechanism wrong. It isn't a single rate hike. It isn't a specific currency threshold. The full unwind trigger is a repo market mechanics event. When the Bank of Japan's overnight rate crosses a specific threshold relative to US Federal Reserve overnight rates, the yield differential that makes the carry trade profitable inverts. At inversion, the mathematical incentive to hold the carry position disappears simultaneously for the entire market. But the structural exit isn't orderly, because every institutional counterparty running this trade knows the same exit math. When the exit math inverts for the entire market at the same time, the unwind becomes a liquidation race, not a rotation, a compressed collateral liquidation cascade where speed determines who exits cleanly and who absorbs the compression. Here is the audit point that changes how you read every Bank of Japan headline going forward. The Federal Reserve's rate trajectory matters more to the yen carry unwind timeline than the Bank of Japan's rate path alone. Here's why. If the Federal Reserve begins cutting rates aggressively while the Bank of Japan continues hiking, the yield differential compresses from both ends simultaneously. That double compression accelerates the inversion timeline. It doesn't create an orderly exit window. It creates a snap. Based on current Bank of Japan rate projections and Federal Reserve forward guidance, the yield differential inversion window sits approximately 6 to 18 months out from current positioning. That's the institutional timeline the clearinghouses are modeling, not the retail timeline. Now let's map what this means directly for XRP's digital asset corridor. During the August 2024 partial unwind event, XRP's order book compression ran approximately 15% to 20% within 72 hours of the initial Nikkei dislocation. That was a partial unwind with verbal intervention backstopping the cascade before full margin call sequencing. A full unwind art without a central bank verbal backstop runs different math. The liquidation cascade prioritizes positions by liquidity. Digital asset corridors are accessible 24 hours a day, 7 days a week. That accessibility makes them prime liquidation targets during a margin call sequence. Institutional counterparties don't liquidate their least liquid positions first. They liquidate whatever they can exit fastest to satisfy the clearing engine's margin requirement. XRP, alongside the broader digital asset corridor, sits in that fast exit bucket. That means when the full yen carry unwind triggers, digital asset corridors absorb disproportionate liquidation pressure relative to their market cap weight in the overall portfolio. Here is what the structural tracking blueprint looks like. Watch the Bank of Japan's policy board meeting schedule and specifically track the overnight rate level against current U.S. Federal Reserve targets. Watch the Federal Reserve's dot plot revisions for any acceleration in the rate cut timeline. Watch the BIS cross-border banking statistics quarterly release for directional changes in yen-funded position sizing. Those 3 data streams will signal the compression window before the repo market triggers the cascade E, not after it fires. The carry trade is still loaded. The rate path is converging from both directions. The liquidation cascade hasn't fired, but the structural clearinghouse friction is building, and XRP's digital asset corridor is directly in the compression zone. Audit the macro plumbing before the cascade runs, not after. To track the exact Bank of Japan overnight rate threshold that triggers the full yield differential inversion, click the related video link right now.